You're watching headlines about war. Markets are watching oil. Because when tension rises near the Strait of Hormuz, a critical artery of global energy, traders don't wait for confirmation. They price risk. And when oil moves, inflation moves. When inflation moves, rate expectations shift. And when rates shift, wealth reallocates. This isn't politics. It's macroeconomics in real time. Roughly 1/5 of the world's oil passes through that narrow corridor. Not theory, not opinion, physical supply. If even part of that flow looks threatened, insurance costs rise, shipping costs rise, futures spike. Markets don't need disruption, they just need probability. Inside Iran, there are reports of significant civilian casualties and serious human rights allegations. Some use strong language, others debate definitions. Markets don't debate, they measure instability. And sustained instability equals higher long-term energy risk. That risk gets priced in, fast. Oil isn't just fuel, it's transportation, it's manufacturing, it's fertilizer, it's plastics, it's supply chains. Energy is the foundation layer of the economy. Raise the foundation, everything above it feels pressure. Oil doesn't just affect what you pay at the pump. It hits the trucking industry first. And trucking moves almost everything. When diesel rises, operating costs rise immediately. Fuel is one of the largest expenses for trucking companies, so freight rates adjust. Retailers absorb part of it. Consumers absorb the rest. That's how oil tension overseas becomes higher prices in your grocery aisle. It's not dramatic, it's mechanical. Higher crude pushes up fuel. Fuel pushes up freight. Freight pushes up goods. Inflation doesn't need to explode, it just needs to stall. If inflation stalls, central banks hesitate. If central banks hesitate, rate cuts delay. If rate cuts delay, markets reprice. One region, global ripple. Smart money isn't watching speeches, they're watching tanker traffic, insurance spreads, OPEC positioning, strategic reserve policy. Narratives move emotions. Logistics move capital. War is tragic. Civilian suffering is real. But global markets are mechanical. They translate instability into numbers, into risk premiums, into pricing models. Understanding that mechanism doesn't make you cold. It makes you prepared. Conflict increases uncertainty. Uncertainty increases spending. Spending increases control. Energy spikes. Debt grows. Currencies adjust. The public feels higher prices. Meanwhile, capital flows where policy points it. So here's the real question. When volatility becomes profitable for some, are you funding it or are you positioned within it? If this perspective was helpful, go ahead and smash the like button. And if you value calm, clear conversations about money and structure, subscribe. We build differently here. I'll see you in the next one.